Steve Call. I'm the president of the New America Foundation, and I'd like to welcome you to this morning's discussion and event. Thank you all for being here. Thank you for paying attention to the deep, complex, structural challenges of energy policy on a morning when the rest of the world is thinking about Afghanistan and the president's important speech last night. And I am aware that this work has always competed in Washington for attention, even though it has shaped so much of our country's economy and potential over the last generation. It has always struggled to sort of be heard as subject matter and policy, and I think that is a lot of what we want to try to work on over the next 6 months here. Just to welcome you formally and to set today's discussion in a very brief context, and also to do just a touch of housekeeping. Just be aware, as the lights and camera suggest, that we are webcasting. Consider yourself in a broadcast environment, so when you speak, when we turn to questions from the audience, or when you're speaking, please wait for the microphone to come. Please do identify yourself. Please be aware that what you're saying is being transmitted, and try to be succinct and cordial and polite. If you have phones that make noise or other devices, it'd be a good time to pay attention to that. You know, I think all I really wanted to do by way of setting the stage for Lisa's work and to thank a few people before we begin is just to observe, as I'm sure many of you here probably represent a lot of this narrative, that the search for a transformational energy policy in this country obviously goes back to the 1970s and has been characterized by not only false starts in that period, but long periods of invisibility and sort of struggle for a sort of center and a narrative that would shape our politics and educate Americans about the issues that are literally underfoot every day in their lives. And I think what brings us together, certainly at New America, part of our premise in this work is that that narrative of false starts is clearly finished. That whatever is going to emerge from the Obama administration and the next administration, we have finally reached the point where energy policy, in a transformational sense, the post-oil and gas universe, it will be constructed one way or another. And I think there are signs that this turn is well underway. First, it's visible in the political character of the discourse, that really the second term of the Bush administration and the Obama administration, you can argue there was a fair amount of continuity in assumptions about the rationale for changing energy policy, not only the global warming debate and the way it changed in the second term of the Bush administration, but also the introduction of a sustained long-term view of a national security discourse around energy policy, the odd bedfellows that have emerged around energy policy, and the bipartisan character of those who are advocating pretty substantial structural changes in carbon-related energy policy. And we'll hear some of that today when our keynoter, Bob Inglis, arrives later. Republican from South Carolina advertising a tax is sort of the kind of thing that a political scientist would take note of as a signal of something changing. And I think also, usually in this town, another way to look for signs of sustainable change in a policy narrative is the extent to which industry starts to surprise you. Where do corporations with ambiguous interests start to change their thinking about policy, but also their own forecasting, and where industries begin to recognize that change is coming and they need to make this an element of their own business planning, that's usually a signal that the change is embedded. And a lot of the I think, debate inside corporate planning groups and executive suites and management committees about greenhouse gas policy and carbon taxes and so forth and cap and trade is driven as much by the need for stable forecasting as it is by any great conviction about how to best balance the challenges of climate change, economic growth, and the energy mix. And so I think that transformation, and you've seen it in healthcare, that's the heart of the story about healthcare, that industry decided that its own planning, its own labor costs, its own employment costs were simply unmanageable. And that really changed the narrative that we remember as failure from the Clinton administration to one that looks like it's virtually finished on the healthcare side. So I think we're about, if healthcare is in the final act of that narrative, we're really at the beginning of that in energy policy, but it's a very, very important time. I think the other sort of contextual point I just wanted to make was that, of the three pillars that the president announced of his sort of transformational domestic agenda when he arrived in town, healthcare, energy, and education, I think the policy subject that we're going to start to tease apart today and over the next 6 months is the one that is the least well examined and the least well understood. I don't know whether it's more complex than healthcare or education. That would be a difficult claim to sustain, but it is certainly as complex, and it's also very widely distributed. I think you could say that in comparison to education and healthcare policy, the problems and the complexity of energy policy and the potential for unintended consequences are much more widely distributed in the system and therefore harder to analyze. And that's explicitly one of our goals in the work that we're beginning today. Obviously, most of the focus about policy transformation is associated with the cap and trade legislation that's up on the Hill. But in fact, the Obama administration has already inaugurated the most ambitious energy policy since the 1970s through the decisions that are embedded in the stimulus bill and the Department of Energy's own R&D programs, through the accumulation and the ratification by the Obama administration of various state compacts and state policies associated with carbon regulation. And of course, the EPA is already well underway with its own review that, irregardless of what happens on the Hill, is going to be an important part of where we end up. So that's the context. What is this? This body of work is time-bound, but very deliberately conceived in a couple of ways. One, at New America, we try, when we work on policy subjects like this and seek a way to make a contribution, to think a little bit in the medium run at a minimum. So 4 to 8 years out, where are the structural lines running? What are the implications of decisions being made today? What underlying changes in the economy or in demography that can be easily anticipated can be traced back to now and wrestled with as presenting implications for policy? And so we formed, and my colleague Rachel White has been instrumental in organizing this, and Lisa Marginelli, who will moderate today's panel, is the director of this effort on our staff. We formed this Energy Policy Advisory Council with an extraordinary array of talented and well-informed participants, several of whom are here today. Just want to point out Zachary Karabell there in the second row, and Jeff Leonard, both of whom are on our board of directors. Christina Larson, I don't know if she's here, but she's a Schwartz Fellow upstairs and works at Foreign Policy. Hi, Christina. Noel Perry, who's the director of our California Leadership Council. Lois Quam, who's had a long career in business and is now an active fellow in intellectual and policy life in Washington. Nigel Purvis and Branko, who will be on the panel as well. I just want to thank you, first of all, for your interest in this. And the idea here, besides this kind of time frame of trying to think out into the medium run and start to anticipate some of the implications of policy decisions today, I think the second principle of this work is to try to interrogate the policy that is already being constructed on the premise that it is less well examined and less well understood than it should be, and that its very dispersal and complexity creates a need, an opportunity for independent thinkers to really, in depth, interrogate the policy for its unintended consequences and for its implications for neglected constituencies. And here, I wouldn't limit ourselves to one constituency or one set of interrogatories, as the lawyers call them, but I do think that we have an interest in thinking about the besieged middle-class households in this country whose rising healthcare costs and declining wages have been the premise of a lot of the Obama administration's reform, and certainly live at the center of a lot of the rhetoric about green jobs and the rationale. And so where do their interests really lie in this suite of complex policies that are now being enacted? And where do the facts lead us in interrogating those policies on their behalf as well as on behalf of the broader economy? So with that introduction, let me welcome the panel to the front and ask Lisa to take us forward from here. Thank you very much for being here this morning.
So I've got your name card.
Do we have enough chairs? Are we?
Here we go. All right.
Thank you very much for coming this morning. And we have a wonderful panel and a lot of ground to cover over the next hour and 15 minutes, so I'm going to be a strict taskmaster here. I wanted to start, the name of this is, the panel is Minding the Gap. And I wanted to give you a little bit of background into what we're looking at. As Steve mentioned, for the first time in a generation, the Obama administration is remodeling U.S. energy policy. And what's happening is that's taking place in a lot of different spaces. It's happening in the stimulus bill to a very large extent. And we're very, very lucky to have Sanjay Wagle here, who's actually overseeing some of that stimulus spending on energy. It's also happening in places like the Waxman-Markey bill, and we also have things like Copenhagen. So it's happening in domestic legislation and also in international agreements. And it's happening through mandates, subsidies, EPA, regulatory changes, and FERC rulings. It's happening all over the place. And the issue here is to figure out how to knit it together and look for its kind of overall shape. The other thing that's happening is that it's happening in a different sort of policy space than big energy policy moves have happened in the past. Because you don't have consensus about climate change, the political consensus to enact kind of sweeping top-down legislation, you have things happening in a lot of different ways, sort of outside this big legislative picture. For example, the Auto Rescue Task Force is another space that this is happening in. And the other thing is that as the space of the policy changes, the levers are also changing. So what started as an environmental movement is now became something about energy security. Then it moved on from there to something that was working through stimulus and jobs. And it also happens in the context of kind of federalization of some of these endangered industries. So what we're looking for here when we talk about minding the gaps is, on the one hand, we're looking at the gap of the 4 to 8 year policy space. And on the other hand, we're also looking for gaps in between these policies themselves and even in our sense of what the whole is. So today we're kind of searching around, maybe like a blind man searching around with a stick, kind of looking at where some of these gaps might be. I want to introduce the panel, and then we'll sort of start in on that first question of where will we be 4 to 8 years from now. Right here to my right. I have a little problem with left and right. Right here to my right is Branko Terzic. He is the leader in global and U.S. regulatory policies and energy and resources at Deloitte & Touche. He started off his career as an environmental engineer. He served on state PUCs. He was the CEO of a large utility. It's hard to figure out where Branko hasn't been. He has been also a FERC commissioner, and he's the chair of the UN Committee on Clean Electricity, and he's also been on the National Petroleum Council. Next to him is Sanjay Wagle, who is the Renewable Energy Grants Advisor at the Office of the Secretary for the U.S. DOE. He was previously a principal at the venture capital firm Vantage Point Venture Partners. Next to him is Doug Koplo. Doug is the founder and CEO of EarthTrack, and he spent the last 2 decades studying subsidies as well as looking at the field of environmental economics. His work has been done for the EPA and the UN and many, many other places. Next to him is Kevin Book, who is Managing Director of Research at Clearview Energy Partners, which is an independent research and consulting firm. And finally, at the end of the table is Nigel Purvis. He's the founder and president of Climate Advisors. He was the senior climate negotiator on climate policy for the State Department, and also the VP of the Nature Conservancy. So what I wanted to do was to start very briefly by having each of you talk for maybe 2 minutes maximum, just saying what you are looking out at as you look at the suite of Obama energy policies, what do you find encouraging and hopeful, and what do you find worrying? Branko, will you start?
Great, thank you. What is hopeful and encouraging is the fact that we have the recognition of the climate change right up front. For the past 100 years, the main policy directive with respect to energy has been to find an adequate supply of energy at reasonable cost to provide reliable service to consumers. Certainly, this has been the policy in electricity and natural gas delivery, and of course on transportation policy, it has been to provide an adequate supply of petroleum for our gasoline fleet. Going into the 21st century, we still have that same objective, but we now have a condition on it. That is, we have to find an adequate supply of energy at reasonable cost, but at the same time, we have to ensure that we don't trip or possibly trip a climate trigger and create a climate change catastrophe. That is, we must reduce greenhouse gas emissions going forward, and probably also reduce the existing greenhouse gas in the atmosphere through possibly some kind of geoengineering. In both cases, now we have an administration which has recognized that second component, that is that we have to meet supply and demand requirements with climate change mitigation. Therefore, we have Waxman-Markey, we have the president committed to some kind of climate change legislation. We've got an EPA moving ahead on its own track with its interpretation, Supreme Court enabled interpretation of the Clean Air Act, which means there is certainty that sometime over the next 4 years we will have some kind of carbon legislation. We will be able to price carbon into our mix, and then from that, capital decisions will be made appropriately, where we'll now we'll price the carbon and then allow the various fuels to compete. Waxman-Markey is a belt and suspenders bill. Not only does it foresee using cap and trade as a mechanism, but in case cap and trade doesn't work, it also has power plant standards, and if that doesn't work, it also has renewable portfolio standard. So we're
just to interrupt briefly,
Yeah.
to move, because I'm taskmasters.
Yeah.
Could you talk about what worries you? Because we are going to get through into some of these.
What worries me is that we bollocks things up in the Congress and Senate. We don't get a bill passed, making it very difficult to make capital decisions. Our energy demand will increase globally. It'll increase in this country as well, even though we've had a temporary setback. My main concern is we will have to live for another 3-4 years with the uncertainty of carbon pricing.
Thank you. Sanjay?
Great. So, good morning. I guess I'm hopeful about the Recovery Act, the stimulus, that it's actually working, and we're starting to emerge from a very severe recession. We saw in Q3 the first positive GDP growth quarter, plus 2.8% after the economy shrinking in the first 2 quarters of the year. And Goldman Sachs and Morgan Stanley forecast another 3% growth, so continued growth in Q4. What worries me is that that hasn't been met by the return of jobs yet, right? So we still have 10.2% unemployment. That's 16 million Americans unemployed. When you look at underemployment, that goes to over 17%. So that's very worrisome. So I'm hopeful that we will see the return of jobs. That's the Recovery Act, the stimulus overall picture. But in energy, what I'm hopeful about is that these investments, we'll talk more about what those are in the area of energy, are actually going to be seen as very good investments that put us on the track to a cleaner and more competitive economy. But what worries me is that this was only a down payment, right? It's maybe $100 billion over 2 years. But what the Center for American Progress forecasts is that we'd need $150 billion of investments a year for the next 20 years to transform our economy the way that we're talking about. So what worries me is what happens after the Recovery Act. And we can talk
Great.
about that too.
Thanks. Doug?
Thanks. Very briefly, I think what I'm hopeful about is, first of all, that the administration is recognizing the importance of dealing with climate change and trying to figure out a way to address it systematically in the economy. I'm very hopeful about the recent G20 statement regarding the phase-out and elimination of subsidies to fossil fuels. It's the highest level recognition of this problem, because clearly it doesn't make much sense on the one hand to be trying to tax or constrain carbon, and on the other hand actually subsidizing emissions of it. I think what worries me the most is that the approaches that we're seeing deployed to do these transformations are heavily reliant on very large-scale centralized government programs. One of the biggest attributes of our country is our market system and the ability to use price systems to send appropriate signaling. And my fear is that a lot of the policies coming out don't use that power and instead are substituting political decision-making.
Thanks. I'm going to go to Nigel next, and then I have a bunch of questions. Kevin, unfortunately, has to leave us at 10, so I'm going to hit Kevin with questions next.
Great. Well, I'm really encouraged by the President's leadership on the issue. He campaigned on energy and climate as one of his top 2 priorities. He assembled a climate change cabinet. He's pushing on a lot of different fronts. I'm concerned about the lack of overlap between international political realities and our domestic political realities. We have about 40 votes for cap and trade in the Senate. We need 60. The kind of agreement internationally that would be necessary to get to 60 is probably not possible given recent statements by China, India, Brazil, South Africa, and other developing countries. So we're on a path that is uncertain in terms of its outcome legislatively at home. We're on a path internationally where it's unclear that what we can bring back is something that would be acceptable to our political process.
And Kevin?
Right, I'll express hopefully not our last hope of the day. I'm extremely hopeful that the administration has recognized the capabilities of America as an innovation system and is looking to actively stimulate innovation. I'm also very excited about finally doing something about vehicle efficiency. I'm kind of an efficiency buff, but the other thing I would say is that the purest form of efficiency is not throwing out what you've already got and you've already paid for. And one of the biggest risks of what we're doing right now is that with all of our focus on transformation and innovation, we're forgetting incrementalism. There's an installed base of capital stock that could be made incrementally better to considerable gain. Some of that is happening in stimulus spending for state energy office retrofits. Some of it probably isn't happening or could be happening more. And then in light of that, there's both a challenge and a risk. The challenge is to find a way to use the fossil energy we're using now better. And it's encouraging to see that the administration has started to consider natural gas, which we have in abundance right now, as an option, have not turned their backs on clean coal. It's a little discouraging to think that we are so reliant on petroleum and yet we're planning a future as if we're not. And so I think that presents a significant risk, and there's going to have to be some gap closing, and I think our lawmakers thinking in the near term.
Okay, Kevin, as I was calling around to people about where are we going to be 4 to 8 years from now, Kevin's answers really hit me. I mean, Kevin studies the oil market as well as policies. And when you look at the last 4 years in the oil market, or if you look at the last 8 years in the oil market, you get an even bigger picture of incredible volatility. So what I'd like you to talk about is where will we be in 4 years and where will we be in 8 years, and what can we learn from that?
Well, there are different answers, Lisa, and I think it's a well-formed question. It's good to hear that the whole thinking of the center is to look at those intervals. It's convenient politically, but it's particularly relevant because for about 4 years, we are in a dangerous complacency with regard to our oil supply because we have artificially contracted demand. And when we recover economically, something interesting is going to happen. It happened in 1980 and 1981 because of CAFE standards. It's probably going to happen now because cars are old and because of new CAFE standards. We're going to cycle out vehicles quickly, and demand's going to be destroyed, and it's going to actually create additional headroom in the global oil system, which will spare us from the true risks of supply constraints. And so the question of where we're going to be in 4 years is we're probably going to be at the tail end of burning off our overcapacity. But what happens is that you move at the margins very quickly. You picture sort of a hyperbolic curve, and that's how price moves. The volatility we saw last year was because we're at 98% global oil capacity. Right now we're at about 93%. 93%, you could take Iran out of the picture, and you might get a $15 move in price, maybe 20. Depends on what the traders are doing that day. Volatility is the real risk. At the end of the day, when we look at sort of the short-term effects, anything that happens fast to price in the short term destroys wealth. And that's the lesson I think that the Congress has certainly taken. They're unclear on exactly what to do about it. The CFTC is unclear what to do about it. But when we look at sort of the 8 years, there's 3 gating questions that I think have to be answered. The first of these is, do we shift the portfolio here in the U.S.? To argue that this is anything less than a momentous task is to ignore 240 million vehicles on the road. And yet, for the first time in my lifetime, there is a serious push for electric vehicles. The federal government owns 1 2/3 car companies. This is an unusual situation where you can look at both alternative fuels and alternative vehicles at the same time with a top-down policy mechanism. So the question is, do we shift portfolio from petroleum to power for transportation? Second gating question. It's do the overseas developing economies that we know will become greater consumers of petroleum surprise us by leapfrogging into more efficient technologies? Do they become surprisingly more efficient, 50 mile per gallon drivers instead of 10, as they go from 15 cars per 1,000 population to 200 in China? I think that will change a lot of the shape of demand. We don't know the answer to that yet. I'm more skeptical that we will shift our portfolio than I am that there will be leapfrogging, because if you look at the growth of the Asian economies, you have a history of leapfrogging. The new technologies were innovated here, diffused there, and adopted immediately with great gains. The third question is, will the Oil Conservation Treaty of 2010, 2011, also known as Copenhagen, come to pass? Because a real price for carbon has 2 principal effects. The first is that it internalizes a cost that I think just about everybody at this point has accepted should exist. They don't all agree on what the price is. But the second thing it does is it will change the way we use oil more than it will change necessarily how much oil we use. We can get a lot more out of what we have right now. There's intermediate targets that have been presented by all the economies meeting in Copenhagen next week, that if they reach them, if we live up to ours at 17%, if you see these intermediate 2020 targets, we'll destroy about a million barrels per day of demand, about 10% of what was expected growth between now and 2020. And that's interesting only because that assumes pro rata, slightly more than pro rata share of carbon emissions made up by cutting your oil use. But you can't cut your coal and natural gas use much. Rich people can be happy in small cars. Nobody can be happy without electricity in an industrial economy. So where there's a lot of flex is potentially for the industrial economies of the world to actually significantly change their use patterns. And between now and 8 years is enough time to make those changes. Retrofit kits for hybrids, for example, something no one talks about, could absolutely be diffused into the population and in the install base of cars. We have shown how contraction can destroy 1.5 million barrels per day of elective petroleum demand here in North America. That happened in this recession. I think structurally there's room for between 3 and 5 million barrels per day of demand destruction. And it all could be done if it's done in an organized fashion. So the 8-year scenario, I think it's going to depend perhaps more than the first 2 questions on what you drive here and what they drive there. It's going to be what price we assign carbon, because that's going to shape very quickly the way we diffuse technologies.
Can you talk a little bit about what's going to happen if we don't sort of manage the risks on the way out? You mentioned when we were talking about the difference between slowly getting to $200 a barrel oil, which you actually foresee sometime out over at the end of the 8-year scenario. I think if I'm
yes.
Yeah, versus quickly getting to the $200. So there's some risks in how we deal with this policy time of these next 4 to 6 years, whether we get ourselves there fast or whether we get ourselves there slowly.
I think it's a risk in execution and also in demographic segments that you're really. I think you may be feeling for the answer since we discussed it a little bit. But let's be very clear about it. Rich economies, rich consumers have the ability to waste stuff. Poor consumers, poor economies do not. It is the irony of the idea of assigning a surcharge to energy that it is the folks with the least working capital and the greatest incentive to change their efficiency who get crushed. That's the problem. It's the folks who know that $1,500 a polyfill would change their electricity bills. They don't have $1,500. Sure, they can get a 15 mile per gallon gain if they turn in their clunker, and the federal government will give them $4,000. Terrific, except that they can't afford the rest of the new car that they have to pay for in the process. This is the ultimate challenge, because if you work on any sort of top-down price superstructure, somebody in there is going to run into that intersection of feeling the fiscal pain but not having the capital endowment to do something about it. And that's not just true for individuals and households here in America. It's true for economies. Economies that have less resilience and greater distances to travel, lower reserves in terms of frankly, a lot of the economies that we think of as wealthy have some pretty high debt to GDP ratios right now. If you look at what we're talking about here, this is going to squeeze some of the folks in the absolute middle.
Okay. I think the other issue that this brings up is that the U.S. is going to need more policy tools to deal with oil. And what you called the Oil Conservation Treaty, Copenhagen, is in a sense a way of extending our relationship to oil for many more years. If we hit a $200 a barrel oil price in the near future, we would be searching for alternatives or trying to switch much more dramatically. And one of the things that you brought up was that we have a lot of ambivalence in politicians as well as those of us in average people, voters, have a lot of ambivalence towards the oil industry, and we may be reluctant to do some of the things that would be economically efficient and may take kind of a long route to reaching the same spot.
Imagine, if you will, I'm about to say something that I'm sure will be controversial. I hope so, because it's intended to be. OPEC is the primary conservator of our petroleum resources. They are the primary thing that stands in the way of the market doing what the market wants to do, which is to clear supply until it's gone at a price that the market will bear. And that isn't something we always like, but it's modeled on something we had here in the United States, the Texas Railroad Commission, which served as the primary conservator of the petroleum resource for precisely this reason, precisely because we'll use as much of it as we can until we run out. So when I call it a conservation act, and I talk about some of these price mechanisms, there's really three tiers. Carbon price is sort of another tier of conservation, if you think about it. It is a superstructure you're putting around your own behavior with the recognition that there might be a problem. And there's a third buffer, which is the strategic reserves we have. And this is an interesting problem, because if you look at our strategic reserve, it's big. 725 million barrels of oil, all in basically 2 states, which all can be impacted by hurricanes also. It may or may not be enough to insulate us against supply risk. It's almost certainly not enough to manipulate price on a global basis for any sustained period of time. My clients, the multi-strategy hedge funds in New York who trade oil, will suck the money out of the treasury and the oil out of salt caverns faster than you can say boo if we start playing price games with it. So should we expand it? Should we move to strategic gasoline reserves? I was called to testify on that a while ago, and one of the questions is, how do you do it? Well, you want gasoline closer to where the people who use gasoline are. There's different grades, different specs, different blends. You're talking about tens or hundreds of billions of dollars in investment to create these parallel product reserves. Or you could come to terms with something that you don't want to admit, which is that we like subsidizing oil. We like it because it makes our lifestyle easy. And it's politically unpalatable, unthinkable, that we would do what Europe has done, which is to essentially say, private companies, we want you to hold larger inventories. We want you to spend your working capital to have more gasoline and diesel fuel on hand in the event of a problem. And we will create a tax regime which is favorable to you for doing this thing. As we look at the challenges of oil security, they're not visible at all right now. But we're potentially in trouble if we don't develop the oil sands as a resource in a responsible, environmentally responsible way, which may or may not be possible, depending on how you define it. If we don't continue to reinvest in U.S. domestic production, and if we don't maintain at least favorable relationships with producer nations, strategic reserves and the thinking about how we can use private industry to further our own lifestyles is currently off the table and probably shouldn't be. Let me offer one final example. there was a lot said about the faith-based initiatives introduced during the Bush administration. It was unpopular. There were many people, my own relatives, some of them included, who felt that it was uncomfortably close between church and state. But in fact, there was an efficiency there. That notion of using what you already have without having to throw it out, that made sense. Well, the U.S. and international petroleum infrastructure is something we already have. It seems very weird to think that we would potentially do very expensive, costly, laborious things when one of the easiest ways to provide for our oil security would be to actually, yes, I know, give money to the petroleum industry, subsidize them to hold greater inventories and greater working capital and change nothing else. It's a weird world where we will finance church-state connection, but not petroleum capitalism connections.
Thank you. Do other panelists want to talk a little bit about this 4 to 8 year period? Nigel?
I'd love to talk about the Copenhagen Petroleum Agreement. As I see the world in 5 to 8 years, we have probably 3 outcomes. The first is that the U.S. has actually peaked in terms of its emissions, and we're beginning to come down. And I say that because either we'll pass cap and trade, or the Clean Air Act will come to effect and begin to bite, or through a combination of energy-only standard-setting, energy efficiency, renewable portfolio standard kind of measures, we'll have turned the corner. We're very close to our peak already, and I think the writing is on the wall. Investors are seeing where money needs to flow. There's been a dramatic decline in the number of coal plants that have actually started being built since the second term of the Bush administration, and you're going to see that. So, in terms of kind of getting out of the doghouse on climate change with the international community and showing that the U.S. is prepared to lead, we'll have actually turned the corner. And yet, the second point I'd like to make is that we won't actually be out of the doghouse, because to solve the climate problem, we really need to engage with developing countries, which are going to be responsible for almost all of the growth in emissions in the coming years. And that means that the test of good behavior, of responsible multilateralism for the United States on climate change is not just what we're doing with our own emissions, but also what we're doing to partner with developing countries to help them control their own emissions. There's a disconnect between the geography of responsibility for action and the geography of opportunity for action, the solution set. And I think the most likely outcome, because of the significant opposition to income transfers to developing countries, to the idea of sending money to China to help modernize their factories so they can outcompete us and siphon our jobs away, all of those kind of political arguments that will be made, whether they're true or not, will make it very difficult for the U.S. to mobilize the resources necessary to really engage with the developing world. We see that already in Copenhagen. The deal that the international community, including Europe, wanted in Copenhagen was not just mitigation by developed countries, but mitigation and midterm financing, meaning financing out to 2020 on the order of tens of billions of dollars a year by the United States. The Obama administration, because it can't guarantee cap and trade, will pass, and therefore it doesn't have a new revenue stream to offer, has pulled back the expectation for Copenhagen so that we have targets by developed countries and a little bit of short-term financing likely to come forward, but not those big-term bucks that are really necessary to engage developing countries. Even if there were an agreement that the president were to agree to eventually, whether the Senate, which would require 67 votes in a treaty ratification process, would actually approve an agreement that would allow those kinds of flows, I think is a very open question. So I think we'll be heading in the right place on mitigation, but probably not where we need to be in the eyes of the international community or scientifically in terms of partnering with developing countries. And then even with respect to our own emissions, final point, we'll have done the easy part. We'll have done the first 10 years. We'll have turned the corner and we'll begin to be reducing. But it's unclear that we will have set the medium and long-term price signals appropriately. And that's because it's politically easy to say, sure, I'm for an 80% reduction from 1990 levels by 2050, but by the next 10 years, I really don't want to do very much, and the slope of the curve is all very tail end heavy, where there are, and to some degree that makes sense economically because you send a clear signal to business that allows them to then build out their capital stock and not prematurely retire existing stock. On the other hand, we know that the science is getting tougher all the time. That the 2 degree centigrade goal which emerged a few years ago from the scientific community in terms of the limit on global warming is probably now considered to be behind the curve and inadequate, and therefore all of the premise of Copenhagen is already a little bit dated, and there'll be, as the science continues to strengthen our resolve to act, there'll be a need to come back and revisit that. And then ultimately we know that the deal in the Senate is not really done, and there's a significant chance that the president's even short-term commitments that he would like to see us achieve in the next decade may be too much for the Senate, and therefore the Senate might buy into some long-term goal with even less action in the near term. So I think that would be my picture. We've turned the corner. We're not doing enough in mitigation. We have a big uncertainty about whether we can really deliver those long-term tons, and we're not financing the international community sufficiently to either have gotten this issue kind of off of the head of state agenda and put ourselves in the mainstream of the developed community.
Thank you. One of the things that's interesting is once you get into that space of 4 to 8 years, you end up looking at juggling a lot of different, there's an awful lot of different things that could happen. And the mixture of the oil market with the domestic and international agreements is just one of those sort of complications. I want to explore this. Kevin, I think, has to leave us at right about now. Okay, thanks, and I'm sorry you won't get to grill him with questions. You'll have to find another way.
Forward my contact information if you'd like.
Okay.
I'm willing to take these.
Thanks. Okay, I wanted to explore this a little bit more. By talking with Sanjay, one of the things that is happening is that there's a tremendous amount of activity in the policy space in the stimulus bill. This is $80 billion, maybe $100 billion for clean energy. It's one of the places where things have really moved very, very quickly. The opportunity for the stimulus bill opened up very quickly, and then the DOE seized on it wisely. And so I wanted to talk to Sanjay about that, and then we're going to talk to Branko a bit about another policy space, which is the smart grid, and they both have very, very different implications. But Sanjay, perhaps you can start by telling us the sort of immediate and longer term impact of the stimulus work that you're doing.
Sure. So the Recovery Act overall was a balance between short-term immediate relief and long-term investments, and with a noticeable emphasis on the former, right? So it's $787 billion overall, of which probably about 2/3 was tax credits to businesses and families, $288 billion, and direct relief to states, businesses and families in the form of unemployment and healthcare benefits, et cetera. The third piece of it, the investments in infrastructure and technology for a more competitive economy, that's where the $100 billion for energy fits in. It's one of the big pieces of that. And through tax credits, grants, and loan guarantees, I think here's a picture of what those investments will have accomplished several years hence. So in 4 areas that I'll focus on. So the first is there's a lot of these investments that are helping to revitalize the domestic auto industry. The auto industry obviously is hurting. That means the Midwest is hurting. And what we're seeing is about $17 billion of public and private investments mobilized by the Recovery Act, loan guarantees, auto loans, tax credits, and grants to companies like Nissan, Ford, Tesla, Fisker, Tenneco, across the supply chain, to retool their factories to produce more efficient cars. So Kevin, fan of vehicle efficiency, I'm with him on that. And when you add this up, you talked about demand destruction, those investments are forecast to, and other administration policies are forecast to add up to about 3 million barrels per day of demand destruction. So this is about reducing oil, but it's also about revitalizing a very important manufacturing sector in the U.S. economy.
Can I ask you what the time frame is on the 3 million barrels a day of demand destruction?
Yeah, so I didn't produce that estimate. I'm citing someone else's, but I believe it's when all of these take place. So the longest term piece of that is the 35.5 MPG by 2016. So perhaps it's by 2016, but I can look that up for you. So revitalizing the auto sector, and a lot of that is about a new emphasis on electric vehicles. So there's $2 billion in grants for battery manufacturing and electric drive vehicle manufacturing. This is something the U.S. doesn't do now, and after these grants, the U.S. will go from manufacturing either 0 or between 0 and 1% of world supply of lithium-ion and nickel metal hydride batteries to being a real world player in battery manufacturing, supplying about 16%. is an estimate by 2012. So we'll go from not having an electric vehicle battery manufacturing capability in the U.S. to being a real player in that sector.
Tell us about some of the other,
Yeah. So the grid, I think Bronco will talk more about the grid, but the president announced in Florida last month the largest investment in history in modernizing the U.S. electric grid, including smart metering, transmission distribution monitoring, grid scale storage investments around the country, about $4 billion in investments to make the grid more smarter and more efficient. Renewables. So we had a growing renewables industry in the U.S. until the downturn and the shutdown in financial markets, thanks to programs like the 1603 grants in lieu of tax credits and other programs in the Recovery Act. We're seeing a restarting of growth in the renewable sector, projects getting financed and built again. There was a big uptick in Q3 after a very slow last year. And also growth in manufacturing. So whereas 25% of wind turbines, for example, were manufactured in the U.S. In 2005. Today, that's over 50%. And after these continuing investments in manufacturing, that's expected to grow to 75 or 80% domestic content on average. And finally, science and innovation. So about $2 billion of the DOE's Recovery Act investments are focusing on restoring American leadership in science and innovation. One of the notable programs is $400 million for ARPA-E, the Advanced Research Projects Agency for Energy. They just received 3,700 concept papers from universities and large corporations and small emerging technology companies for advanced breakthrough concepts that can help us address climate change and our energy challenges. So I think that's a picture of kind of four of the areas where I think the Recovery Act will have major impact.
Can you tell us a little bit about the theory of the leveraging the investments?
Sure. So, Doug talked earlier about large centralized government programs, and we should harness the market. And I totally agree with Doug. I think that's what the Recovery Act does. The Recovery Act investments, we could have done this a lot faster if Congress had said, okay, Department of Energy, you spend $100 billion and you decide how to do it. Actually, what we're doing instead is providing tax credits where there's a 30% incentive, but 70% from the private sector, or loan guarantees where there's a liability on the government balance sheet, but the debt and equity are coming from the private sector, or even the grants are cost shared. On average, for every dollar of government grants we're giving out in the Department of Energy, that's matched by another dollar or more of private sector capital, often several times that, depending on the program. So I think these investments and incentives are mobilizing private capital, harnessing market discipline, right? So we're having a lot of very oversubscribed competitive solicitations, and we get to have the market tell us what are the best ideas for investing profitably across the economy.
So here's a question that I have, which is you spent years in the venture capital community out in Silicon Valley, and out there's a whole culture of risk and reward. And if you're traveling down 101, you see the people who've won the rewards go flying past you in the fancy cars. And there's also a culture of punishing people, some sort of punishment. And what happens when you're a venture capitalist working for the government?
Well, let me answer it by saying there's a lot more rules and a lot more transparency. In venture capital, I don't have to explain myself to anyone except my partners. I just do whatever I think makes sense. In the government, and in investing these funds on behalf of the American taxpayer, we have to do it through public solicitations. There has to be an integrity of the process with no political interference, and there has to be equal and open access to these opportunities. Having said that, so that can make it slower and more cumbersome. We're trying in the Recovery Act team in DOE to make sure we do it as fast as possible. But there's actually some advantages as well. So there are some things you can see through these public solicitations that you would never see in a venture capital firm or an investment bank. I mean, when you look at the 3,700 concept papers we got at ARPA-E, we saw a venture capital firm may see every single startup in the Valley or around the country. But I don't think any single VC firm has ever seen that degree of deal flow. And teaming among large corporations and startups and universities formed explicitly for the purpose of responding to this solicitation. So I think we saw a mix of concepts that no VC had seen. Similarly, in the loan guarantee program, I think that deal flow pipeline is probably deeper and broader than anything seen at any one investment bank or institutional investor.
So I think one of the open questions, though, is, and maybe this will simply remain an open question, is how do you win when you're betting for the government? You know, the venture capitalism is a game of winning and placing good bets. And I'm wondering, as we go down, and maybe we can leave that kind of for an open question, unless you have a quick...
So I think in the short term, how are we measuring success? In the short term, we're measuring success by how quickly we get this money out into the private sector and how quickly we create jobs. In the long term, we're going to be measured by how competitive that makes our economy, how much we increase, do we achieve our goal of doubling renewables in the next few years, do we reduce carbon emissions? And there's actually a whole set of metrics so we can report to the American people how well we're doing in that regard. And those metrics are reported by each grantee and posted on a website for everyone to see. And they're aggregated by the Office of Management and Budget, OMB. So.
Okay, great. Thank you very much. There will be time for follow-up questions after. I wanted to have Branko talk a bit about the smart grid because it's such a complicated, it's such an interesting thing. It's something that's been a bit of a sleeper concept in American policy. It has tremendous potential both as a job creator and as an innovation sort of engine, and in changing the way people use their electricity. It also is just this incredibly complex mix of jurisdictions and incentives. So, Branko, perhaps you could start by talking a little bit about the potential of the smart grid and some of the bumps in the path.
Yes, let me first disabuse you of the notion that we have a national grid. We probably should always use the plural grids. There is no national grid that takes power from New York to California. We have regional electric transmission systems, tightly connected in some areas, loosely connected in others. The transmission systems are owned by predominantly investor-owned utilities, other than some transmission owned by federal agencies, the TVA, Bonneville Power Authority, Salt River Project. So predominantly we've got a grid that's investor-owned. The expansion and addition of assets to the grid is regulated by the states. If you want to expand a transmission system or build a new transmission system in one state, the piece that's in the state gets regulated by that state. So if you're going to build a new transmission line across 3 states or upgrade a line across 3 states, you have to go to each individual state regulatory agency, usually the Public Service Commission, to get approval within that state for the investment in that state. Unlike interstate natural gas pipelines, where you can go to the FERC, Federal Energy Commission, to get a multi-state eminent domain and a multi-state license. So number one, these are state-regulated assets predominantly. Number two, we need more transmission. So we even need more of the old dumb grid. If we had more and these have been identified, the locations where we need just plain dumb transmission are locations that would allow us to access large amounts of renewable energy. The large wind, the large solar farms that would have to be where the sun and the wind are not where the consumers are. Just if we had more plain current existing technology transmission systems, that would allow more renewable and other energy to come. Also, we have many parts of the country where just expanding the existing transmission system would allow idle capacity and low-cost capacity to go to areas where there is high-cost energy. That would make the system more efficient. It would lower rates to consumers. All those studies are out there. They're filed at various agencies of government. Now we come to the smart grid. The smart grid is basically the combination of the electric power system with our communications infrastructure, with our wireless internet, with our telecom system, with whatever you want to call it. But it's a combination of the two, and adding to that the technologies to be able to more effectively measure and monitor what's happening on the grid so that we have higher utilization of lines, avoiding unnecessary capital construction. Right now, a lot of lines are considered loaded because of rules of thumb. If we actually measured those lines, we'd be able to put a lot more electricity on them, making the whole system more efficient, avoiding capital investment. Secondly, we can make the distribution systems more efficient, and our customers, our consumers, can use the smart grid and connect their intelligent devices. You know, people don't use electricity; your devices do. Your water heaters, your air conditioners, your motors, all of these devices use electricity, and if we can, and when in the future they will come with computer technology, smart technology, so they'll be able to receive signals as to when prices are better. You'll also have distributed storage, possibly the electric vehicle that you plug in at night could be used as a storage device by the grid. Billions of electric vehicles plugged in at the same time could be a huge storage system for storing wind power, for example, when the wind is blowing, and then putting it back into the system in the other direction, from the homes, from the parking lots, from the businesses, sending electricity both ways. All of that very complicated sending and receiving of electricity in two directions, which we don't do now because of balancing and other problems, will be facilitated by having smart technology, smart metering, smart data communications, and also smart pricing. So the benefits are going to be overall efficiency, less capital investment, and cleaner air.
And what I think is interesting here, and one of the pitfalls is, we have the option of building a smarter grid, and we have option of building a really smart grid, and we have the option of building a really, really smart grid. And part of that is not about the grid, it's about the markets. And maybe you can talk a little bit about some of the price signals and the things that we have to get.
Well, one thing we're going to need, beyond a smart grid, we're going to need smart tariffs. So we're going to need pricing systems that allow us to accept the functionality of sending pricing signals so that devices can turn off and on, can cycle, we can use the storage and the other things. There is also a price tag to this. Unfortunately, as a public service commissioner, which I was in Wisconsin, if I have to approve $1 billion of smart grid investment under our current regulatory system, that $1 billion increases the rate base of the utilities, and it increases rates immediately. The minute that capital investment comes on, it increases the investment that's serving you, and your rates go up. Now, there's a long-term benefit in that we'll avoid building new power plants, we'll avoid building possibly new transmission lines that we don't need, but this is that constant trade-off that state regulators have to make between a short-term increase in costs and a long-term benefit. And these are very difficult decisions to make today, when you've got 15% unemployment, when you've got consumers pressed with debt, when you've got consumers pressed with mortgages they can't pay, to also voluntarily at this point in time decide to allow the capital investment in the smart grid. One of the benefits of the stimulus package was to allow some funds from the federal government to lower that capital cost. But even in that case, there are state commissions which have rejected smart grid proposals on the basis of, it's too much money now, let's wait for later.
Right, and there is this risk of a political backlash, which is I think, kind of interesting. Consumers may not want the smart grid, even though 10 years down the line it could dramatically change their lives.
There are consumer advocate groups have opposed the installation of smart meters on the basis that there isn't enough benefit now, it's too much expense, and we can do it later. This is documented.
Can you just give us a very quick hit on your experiences with the phone market? In many ways, what we're doing with the smart grid is we're trying to create a market for products that don't exist. We don't know what's going to be in that market, and I think this is just a really interesting parallel.
It goes back to Peter Drucker's statement that you can't ask a customer to design your product for you. The customer doesn't know what they want. They can't tell you they want you to invent the iPod. They can't tell you they want you to invent the cellular phone. Now, I'm old enough where I was a regulator who licensed the second cellular telephone system in the United States in 1986. That phone cost $2,500. Service was $50 a month plus 50 cents a minute, Milwaukee Telephone Company. And we were told by everybody that this was, by consumer advocates, that this was purely a toy for the wealthy. Poor people and middle-class people would never be able to afford this. Well, technology beat it. And we talked about leapfrogging technologies. Much of the third world got cell phones before we did here in the United States. Think about it. Ericsson had the first cell phone system in Sweden, not in the, no, that's not third world, but I was in Montenegro a couple of years ago in 2000, in 1999 and 2000, Montenegro. The medium income is $200 a month, and everybody had a smartphone. They had it because of the ability to have a prepaid card, so you'd buy $10 worth of minutes, and that was it. Nobody foresaw that people with $200 a month income would afford a cellular phone. So, you know, this is that public policy decision of introducing the new technology, letting it run, and then seeing the benefits from it.
Great. I want to quickly move on to talk to Nigel a little bit about one of the other things is sort of the political fallout and its effect on policies. One of these would be this issue of border tariffs and how that might influence the way that we deal with greenhouse gas policies.
Yeah, so there's a little bit of a disconnect between what the Senate is looking for and what the international community and the developing countries are looking for. So over the weekend, we had China, Brazil, South Africa, and India released a statement saying that the Copenhagen Agreement absolutely must contain a prohibition against the use of border measures for climate purposes. So this would be the application by a country of a tariff or an adjustment to the price of a product as it entered if that product were produced in a country that did not have comparable greenhouse gas standards. And the Senate, we're likely to hear actually later this week from a number of moderate Democratic senators who we've been hearing from regularly this year that this is absolutely essential. It must be in Copenhagen or in the WTO or in something else. So there's a real conflict brewing here. But what's likely to happen is that there will be no agreement in the international process, and the Copenhagen Agreement and the WTO will just punt on this because there is no ability to achieve consensus. What that means is that each country will then decide what it wants to do under its own domestic system. And I think it's pretty hard to imagine a cap and trade bill or really any ambitious climate action passing the Congress without some kind of border measures. In fact, you have John Kerry, who initially was opposed to this issue, who signed on to an op-ed with Lindsey Graham saying border measures for it. So we're going to have them. And there's a real question about whether that measure, which we think is going to protect the competitiveness of our companies in energy-intensive and trade-sensitive sectors, is actually going to work the way we intend it. Because if we're doing it, then other countries can do it as well. And there's no internationally agreed-upon standard for when you impose these measures. And you can easily imagine India, and in fact they've already said publicly that they would consider pursuing this. You could imagine them imposing a border adjustment against any product that is manufactured in a country whose per capita emissions are greater than a particular level, or that is not reducing emissions in line with the IPCC guidelines about what's scientifically necessary. And under either of those scenarios, U.S. products would be subject to border measures in India because our emission reductions will be smaller than the IPCC is recommending, and our per capita emissions are among the highest in the industrialized countries. So what we're envisioning as a protection against China could easily be used by other developing countries as a protection against U.S. products. And so this interaction between our economy, including our energy economy and our clean energy economy, and our climate policy is, I think, highly uncertain.
And our domestic politics have some sort of fallout on that policy and potentially on industrial policy. Okay, I wanted to move on quickly into the realm of the things that you can't foresee, but maybe if you look closely enough at them, you can foresee them, is to have Doug Koplo do kind of a short presentation on some of the subsidies and in the... Here you go. So those of us who are panelists will have to move off the stage while Doug does his presentation. But he's going to talk, the influence of subsidies in this particular energy policy is huge because it's one of the few spaces that's available.
Thanks very much. I'll try and run through this fairly quickly. I think there's a lot of issues with the structure of our current policy that are worrying and warrant some additional attention. We're seeing an ever larger scale of government intervention in energy markets, whether through mandates such as the renewable fuel standards, in an effort to put the federal government in a central role in terms of financing new energy infrastructure through Title 17 or the Clean Energy Deployment Administration, and through a whole bunch of very detailed decisions on the allocation of initial carbon credits under cap and trade. We're talking financial impacts on the order of hundreds of billions or trillions of dollars. One of the issues here is not just the scale of impact, but the fact that the government involvement is, the programs tend to be government-directed or government-led, rather than having a more abstract market goal and letting markets kind of help us get there. So we see things like technology-specific carve-outs in the renewable fuel standards to protect the biodiesel industry. We see efforts to ensure that the grandfathering under those rules will protect the entire base of corn-based ethanol production from any environmental constraints that might be put in place there. We see carve-outs for specific types of energy under the loan guarantee programs. And all of these things are sort of politically driven rigidities that create a situation where the government, when it sees a problem in a fuel chain, its immediate goal is to try and go in there and subsidize that problem away, whether it's high carbon in coal, whether it's long-term management of radioactive waste in the nuclear power sector. And I think we should be looking at it in an opposite way and saying, how can we force these problems through to end-user prices so that we can see a greater distinction across the complexities of the fuel chain. So in addition to hopes and dreams of green jobs in the economy, it's quite important that we also focus more on the more boring but quite important checks and balances, and also to some of the implications of these policies as they scale up. So it's great to think about cellulosic ethanol and switchgrass as an environmentally benign solution on a small scale when you can grow it in its native habitat. But when you start scaling up even cellulosic biofuels to address 40 or 50% of the U.S. demand for gasoline, you have dramatically different impacts in terms of impacts on food markets, requirements to use inputs of fertilizer and water and so on. And I think we need to do a much better job thinking about them. The scale of these programs is staggering, and I think we're sort of inured to it because of all the bailouts that we've seen over the last 2 years. But over in this section, this bar chart shows the new loan guarantee programs, and they're dramatically higher than historical DOE spending on energy R&D. We're talking capital amounts that are larger than the portfolios of OPIC and the Exim Bank, and yet those are institutions that have been around for much longer. They have a more diversified portfolio across countries and across industries, and yet we're trying to ramp up very large lending capacities overseen by mostly political appointees, and there's a very high risk, in my view, of misallocation of capital. Another issue that I think is important to think about is a lot of the government initiatives are focusing on technology. Now, energy technology is important, but it's not the entire story. There's an implicit assumption that if you build it, if you get the technology, it will deploy almost automatically in the marketplace. This is a framework for transformation that was developed by Innosight LLC, which is a Boston-based firm run by Clayton Christensen of the Harvard Business School. They study structural transformation in all industries, not just energy. And what's intriguing to me about this is that technology is just one piece of it. The business model and the market structure are equally important pieces and aren't getting enough attention in energy policy. And I think that's a problem. And you can see in the photovoltaic market, for example, a lot of the recent innovation has been in delivery of PV panels, assessing the adequacy of the site, providing financing, technology selection, installation management, and those are very important elements of any type of deployment of technology. The risk of so much government involvement here is that capital allocation becomes politicized, and this is unfortunately a bit difficult to read. It's a marginal abatement curve for carbon that was developed by McKinsey and Company. Down here you have very efficient, low-cost or negative-cost ways to pull greenhouse gases out of the economy. A lot of these things are efficiency in systems management or alternative energy. As you move up the curve all the way to this side, these very high costs per metric ton of CO2 equivalent abated are for new build nuclear power and biofuels, and this reflects not only the private costs but also the public subsidies that we're deploying in this area. And I think this is important for a couple of reasons. First of all, it says that if we were reliant on a market to find the lowest cost abatement strategies, these technologies would never get it. But they are politically well connected and therefore are getting a lot of money. The other important attribute of this chart is just to show how critical it is to have metrics to evaluate what we're doing across sectors and across policies. And unless we have a way to normalize what we're spending and what we expect to get at the end, we're not going to be able to see these types of trade-offs and therefore make better policy decisions. The basic point here is that while you can't predict in advance what technology is going to succeed, you can do structural things in the policies to make the chance of success higher or lower. And this will be, I think, posted on the website. I'm not going to go through it in detail. But issues like, are you subsidizing the investment side, or are the subsidies delivered at the end point after a product has been produced? Are you making a small number of very large bets, like we're seeing under CETA, where a single facility could get $3 or $4 billion in loan guarantees? Or are you making a larger number of smaller bets? All these types of strategies can increase the likelihood of a program succeeding. Now, what I've done here is I've taken the Clean Energy Deployment Administration, which will be $100 billion or more in loan guarantees to private facilities, and tried to rank it based on some of these criteria. And the important issue to see in general is that, unfortunately, under most of these criteria, CETA is showing up as gray. That means it's got a structure that, in my opinion, is going to have a lower chance of success rather than a higher chance. And that's true in terms of how the resources are allocated, in terms of how the technology is selected, how the program is overseen, and also how you measure performance, and importantly, when you start seeing failures, can you do mid-course corrections? So this will be up on the website, and I hope that people will look at it. But this type of approach, I think, can be used effectively to look at a lot of the strategies that are being proposed going forward. So thank you.
Thank you very much, Doug. What I'm going to do now is open up the floor to questions. And we also hope to dive deeper into some of these issues. For example, Doug's work on CETA is something that we'd like to explore later on in a forum later on in the next 6 months. And actually, virtually everything that's been discussed up here is something that we plan to work more on. Yes? Oh, and the Congressman's here. So we have about 12 minutes for questions. First question. And please keep your questions brief. We need to get lots of people in.
Okay, there was quite a bit on grids. And since my simple question, since we have a public highway system, which has turned out to be very successful, are we going to have, as a default, do we have to have a public power grid and information grid?
I guess that's to me. No, I don't believe we do. One of the issues is a resource allocation. One of the benefits of the U.S. system is that private capital is attracted under our regulatory system to build out our electric, our natural gas, and our telephone. We don't need public capital, and so if you don't need the public capital, you don't need the public ownership. The money is out there to finance the grid. What we're missing is the regulatory scheme that will attract the money on reasonable levels, and state public service commissions, and in some regard the FERC, having their regulatory policies in that will enable the building of the grid. I'm firmly convinced that the smart grid will come. It'll just be later in some locations than others.
I think this is one of the interesting things, is that the money is not the problem here. It's the capacity, in a sense. Zachary, would you?
Yeah.
Have other people answer that, so we have more than one
Did anyone else want to answer?
I would especially like to hear from Mr. Riley.
Sure.
I'm not sure how much I can add to that. I mean, grid is not one of my areas of expertise, so can't help you.
This takes off from Doug's presentation, but it's actually relevant to all of you, so take which one you want. What is, in a political context, there is, or at least there can appear to be, a real trade-off between efficiencies and job creation. So, part of your scoring issue goes to the things that look like big projects, and you talked a bit about the grant-driving part that is linked to job creation, right? How do you square that particular circle? Because often efficiencies do not easily, or at least intuitively, coincide with the kind of expenditures that lead to job creation. And we are in a particular political climate where there's a need for efficiency on the one hand, but there's this pressing political need to deal with underemployment. And how does that circle get squared in a political context?
Yeah, I mean, there's the whole left-hand side of the carbon abatement curve, and how do we promote that? So, and how do we promote that through the private sector, I think is really your question. There's $11 billion of grants in the Recovery Act for efficiency investments, weatherization of low-income homes, and grants to states to implement efficiency in their states, states and local governments around the country. But the big win would be going beyond those grants and promoting more energy efficiency retrofits and energy efficient design in the private sector. So one way the department's working on that, together with EPA, is appliance efficiency standards and green building standards. So when the Recovery Act was passed, in order for states to get Recovery Act money for energy, the governors had to write a letter to to Secretary Chu, certifying that they had a plan in place to adopt green building standards. So there was a string attached to those funds, and I think that's a very important way to do it. Those standards drive innovation and greater efficiency in the marketplace. But beyond that, a big win would be finding financing solutions to enable greater efficiency investments by the private sector, both in industry and in homes. In industry, there's an interesting thing. A piece of the Recovery Act was on industrial efficiency grants, and that portion of it was highly oversubscribed, and with about $5 billion in proposed investments in efficiency measures in industry, manufacturing and heavy industry primarily. Very energy-intensive industries with profitable ways to adopt efficiency measures and combined heat and power, things like that. On the home side, we're looking at ways like energy-efficient mortgages. So every time a housing transaction takes place, every time you buy or sell a house, requiring an audit that would provide information to the buyers about the efficiency, but then also being able to fold in investments at that time into the mortgage, and hopefully a lower cost mortgage, to implement efficiency measures. So there's some things we're looking into.
Doug?
Yeah, I guess in terms of this whole jobs creation thing, I'd like to see more rigorous information on job creation. It's not gross jobs created that really matter, it's net jobs. And when you are doing things that are increasing costs in certain sectors or deploying capital in ways that it wouldn't otherwise be, you're sometimes destroying jobs in other parts of the economy. That part of the equation isn't counted. It should be. And I think doing it would help ensure that the places that money went was really creating net jobs.
I think one of the things that came up also in talking with every panelist was the need for better metrics, and the need for more sort of analytical systems for judging whether investments were going to pay off and how they were going to pay off, whether it was jobs or carbon abatement. Let me take a question from in the back. No, that is the person right behind you. Oh, it's Henry. Okay.
Well, Doug's commentary was kind of hanging out there. So I just want to get a quick take on it. You applied the kind of big versus small, the decentralized versus big bets dynamic to CETA, but I was wondering from maybe Nigel and Sanjay, applying that concept to, say, the carbon market or ARPA-E, do you think the same, disproportionalities going on, or do you think, say, the carbon market could be a decentralized sort of funding source, a kind of, wide and broad bet, and the same going for ARPA-E and that structure of investment versus these large capital-intensive CETA investments?
Well, I appreciate the opportunity to weigh in on that. I very much agree that there are a lot of the spending that is occurring in the energy area that is not in our national interest, and we need to eliminate environmentally harmful subsidies as quickly as possible, and to ensure that our energy and environmental policies are mutually supportive. That said, as I read the McKinsey cost curve, what it's saying is this is all of the abatement that needs to happen. We don't have a choice of just doing the left-hand side. We need to do all of it, and it's a question of timing. We want to do the left-hand side early so that it's the stuff that we can afford, but we need to innovate the right-hand side so that at the time that we need to reduce those emissions, which we will need to do, it's more affordable. And I do think that there's a role for government research and for early research prior to commercialization on those large transformative technologies. In that regard, I'm encouraged by the fact that the Congress has appropriated significant funding for things like clean coal and for the transformative biofuels that always seem like they're just a few years away and yet haven't come. So, and we're going to need innovation on that side, and it is expensive. And if we leave it to the private sector, we will run out of the cheap tons. And so I think that there's still a role for that government involvement on the large projects.
Well, about ARPA-E, so we so far have funded about 37 research projects. That was out of 3,700 concept papers. So luckily, we got to be as selective or more selective than is typical for VC firms when they make investments. We got to review for every 100 concept papers we received, we got to pick one. And so because of that, it still covers a very broad range of technologies. But I think the best way to look at that is not picking winners or picking technologies, but the way the Secretary Chu talks about it is most of these concepts won't work. They're very early stage and very far out, high risk, high reward research projects. Some of them may work. And if even one of them becomes a game changer, the way that the invention of the transistor was in the 50s, or the invention of the Haber-Bosch nitrogen manufacturing process that enabled fertilizers. If just one of those becomes a game changer, it gives rise to whole new industries that will have tremendous impact on our energy use, on our national security, on our economy and our environment. So,
I think also in talking with Branko, you mentioned that the other issue is whether or not there are international treaties around this sort of thing. Because for example, if it's better to suck up CO2 in Greenland with using geothermal energy, you would want to be able to use you might have certain game-changing technologies that are only applicable in certain locations, and they might make a tremendous amount of sense, but they might make sense nowhere else on Earth.
Well, I think the politically sensitive question is how would we approach the issue of geoengineering? It's been talked about. There was a Foreign Affairs article recently by a number of scientists and others, and that is, what if we could demonstrate to you that it's cheaper to put some remote carbon capture devices out in Greenland, where there's, let's say, abundant geothermal energy but no customers? What if it's cheaper to do that than to do carbon capture, sequestration, or clean up a coal-fired power plant in the U.S.? What are the ethical, what are the moral, what are the economic considerations of that, so that what you'd have is the producer of CO2 in Ohio writing a check to the capture of CO2 in Greenland, who would be removing the same CO2, let's say, that's coming out, and then having that balance. Those are the kinds of international discussions that I think we need to have, because they're not single country facilities, they're global facilities and will require a global market, global cap and trade scheme, global emissions regime in order to make that work.
And all of that makes that whole carbon bank concept that much more complex when you add the other ethical issues into it. So we're now precisely at 10:45, and we have Congressman Bob Inglis here. I'd like to introduce, first of all, I encourage you all to come and buttonhole the panelists afterwards, or buttonhole me if there's questions that didn't get asked. I want to know your unasked questions, and I will write them down and take action on them. And I wanted to introduce Jeffery Leonard, who's going to introduce Congressman Inglis. And thank you very much to our panelists.
Yes.
Thank you.
Bob's taking his seat of honor. Welcome. So, good morning, and on behalf of my co-chair, Zach, who was right here a minute ago, I'd like to welcome you all and thank you for attending, and echo both Steve's and others, Lisa's others' comments here this morning that we have great hopes that this panel can begin to, as we go forward in the next 6 months, look at some of the piecemeal nature of all these energy policy initiatives that we heard about this morning across the board, and try to make sense of them. And we don't necessarily start from the premise that we believe in national energy or national industrial policy, but the fact is that over a long period of time, de facto, we will end up with a patchwork of either conflicting policies and so on that work for and against positive energy initiatives, or we could end up with a more, here in Washington, a better outcome, which is more tailored to the American system, economic system, and our long-term national interests. I heard this morning a lot of pitfalls that could be coming from some of the current fervor about energy policy. It's great that there's this intense concentration on energy policy. It's the first time since I was in the early stages of my career in the 1970s that we're hearing this kind of interest. But we heard a lot of concern, or some concern anyway, from Kevin and Doug and Bronco in particular, about some of the hype and the political push surrounding green job recovery. Is it really green jobs? Are they permanent? Are they enduring in this economy, or is it just kind of jobs for the boys kind of initiatives? I heard some concerns about the wariness of picking government policy, picking technology winners in the long term. Can government really do that? Should it do that? We seem to be on this never-ending search in the United States for the next magic bullet technologies. They are always seemingly right around the corner, but often we don't concentrate on what's right in front of us in terms of the easy things to do, the cheaper initiatives sometimes. There's certainly a huge danger, continuing danger here in Washington, of many of these energy policies turning into protectionist policies, as we heard, white elephant projects, and pork barrel everywhere. I mean, half the items in the energy bill really amount to pork barrel for somebody's district, more than they amount to great energy policy at this time. One peril here in Washington for us all to really concentrate on, I didn't hear it this morning, was green energy or clean energy lobbying in this town. Expenses has gone up tenfold or more in the last 3 years. It now exceeds the lobbying of ExxonMobil in cost. So we're creating a whole new energy industry here in Washington. Certainly that should not be seen as a good job stimulation industry in my opinion. On the other hand, and I want to be really positive here, and because I think this is where it comes in to Bob Inglis from my standpoint. There's some really great, exciting things that we're hearing out of energy policy, out of all this, the haze of these different conflicting areas. Nigel and Sanjay just talked about it, the ARPA initiative, the focus finally on long-term R&D initiatives. What are the technologies where government and only government spending in the long term can help us develop for the next 10, 20, 30 years? The private sector won't do those initiatives. The focus in the bill, we hear the public rhetoric and the media rhetoric on renewable energy, but so much of the stimulus and the new energy bill focus and ultimate spending in the next 5 to 10 years will be in the areas of energy efficiency and smart grid. We have ignored these areas, as we heard the panelists say over and over again, and there's a huge amount of spending potentially in those areas in the next few years. EPA is back in the game, finally. First new regulatory initiatives in more than 17 years. We're hearing the potential for CO2 regulation and the Clean Air Act enforcement is going to change a lot of industries. Green building, everything comes back green after the recession. In the building industries, we're retooling the trades, as we call it, the cash for caulkers initiatives. The focus and the policy focus, again, on thermal energy and recycled energy recovery will be profound and create whole new industries in this country. So how do we get there? The real issue for me is how do we get to take that small patchwork of positive initiatives and develop over the time, hone them into energy policies that really focus on promoting national security, helping to reduce our trade deficit, assuring adequate supply of energy for the American economy, and reducing greenhouse gas emissions in the long term. We need comprehensive, progressive thinkers in our Congress and in the legislative arena to help us do that. There are honestly very few on either side of the aisle who are thinking out of the box in these areas. Most are speaking to specific and narrow interests, as we said. I think Republican Congressman Bob Inglis from a very conservative district in Greenville, South Carolina, epitomizes to me the idea of nonpartisanship, initiatives outside the box, folded into the good old American trends of stimulating the private sector, getting the American consumer to really help us pull through rather than just focus on what big government can do. He's an innovator. He's a six-term Republican. It's very unusual for a six-term Republican to have his primary imprimatur in the Congress be around the areas of science, technology, energy, and environment. And let me just conclude my introduction of Bob with a brief story. He and I were on a panel recently that was sponsored by The Week here in Washington, and we were on it with Congressman John Dingell and also Representative Joe Barton of Texas. John Dingell, of course, longtime defender of the auto industry and so on, but increasingly a supporter of big environment initiatives. Joe Barton, probably one of the most conservative individuals in our Congress, started out, asked a question about climate change. He said, there is no problem. There's no climate change problem. I am a mobile source emitter. I emitted X amount of tons of CO2 last year. You can't regulate me. You can't regulate everything in this economy. There's no problem. The moderator turned to me and asked me, well, Dr. Leonard, what do you think about that? And I wasn't going to touch that with a 10-foot pole because to me, that's not a debate we should be having anymore. So I was silent. Bob Inglis, first of all, the guy from Shell said, well, to Shell, we're one of the largest oil producers in the world. We're a big problem, contributor to the problem, but in the long term, we see huge business opportunities in these new areas of energy and so on. That will remake the world economy, the energy supply in coming years, and as a long-term player here, we're going to be involved in developing all these new technologies. Bob Inglis said, well, we just created 1,200 jobs in my district with a wind turbine manufacturer coming in. And I'm thinking about technology, innovation in our economy, competitiveness for the American, clean, good jobs in new industries, energy security, a sustainable economy. To me, it's not about the science of the climate change. It's about the future of our economy. And I just looked at Bob and said, case closed. Here we go. We got it's your party. You guys figure it out. But so I think Bob Inglis, he told me recently, though, that he is facing a big challenge in his district because of his views on these things. But we'd love to hear from him this morning, and particularly his new initiative to deal with energy policy.
use this. Does that work? Is that all right? Thank you, Jeff. Wonderful to be here, and thank you for the New America Foundation for being really sort of old America. You know, as I understand it, the Founding Fathers really didn't like the idea of partisanship and really didn't like the idea of dividing into political parties, actually. What they really wanted was people who would serve the American interest. And so what Jeff has just described, I think, is the American interest. We have a tremendous opportunity, if you look at it the right way. Now, of course, I had a primary opponent last time, 2008, who told me doom and gloom is what we're talking about. And every time he'd say doom and gloom, I'd say, Charles, it's promise and opportunity if you just seize it. And so now I got 4 primary opponents. So they seem to be proliferating. Here's my contention. As a conservative, I believe that the definition of sustainability is making a profit. I heard this recently from Carlos Gutierrez, who's a manufacturer in Spartanburg, South Carolina. Typical of people in our area, he came to work for Milliken. He's a Georgia Tech engineer, came to work for Milliken, went out on his own, recycling X-ray film, taking the silver off of X-ray film. Well, that business started to dry up, you know, as X-rays on film went the way of the hula hoop. And so now it's on digital. And so he needed to do something else. And so what he figured out a way to do is to recycle PET, the stuff that makes plastic bottles. And he's able to sell PET, recycled PET, back to Coca-Cola at a price point lower than virgin PET. And when the virgin manufacturers heard about it, they said, impossible. He said, watch me. And the key to it is he doesn't melt it. And if you could see his process, it really is amazing stuff. So he gave me this definition of sustainability. He says sustainability is making a profit. If you can make a profit, it's sustainable. If you can't, it is not. Now you can have all kinds of government prop up with credits. We Republicans tend to like tax credits. So you can prop it up with tax credits, or you can prop it up the Democrat way through subsidies of various sorts and grants and programs like that. Or you can just set the economics right and watch the free enterprise system solve this problem. And that's what I'm here to suggest is the way to get there, because I believe that free enterprise is the solution to our energy challenge. Here's how I propose to address it. I voted no on cap and trade. I think it's a 1,200-page monstrosity of enormous complexity, a tax increase in the midst of a recession, which I don't think any economist would recommend. It is a trading scheme that would make Bear Stearns traders blush, and it punishes American manufacturing to no effect on the environment. Because if we do this to ourselves and China and India are exempt, well, what have we accomplished? Absolutely nothing. So here's what I'd suggest. Compared to that 1,200 pages, I've got a 15-page bill. It can be read, 15, 20 minutes. You can get through my bill. It's an idea that Art Laffer and I have been working on. Art Laffer, you remember? It's Ronald Reagan's economics advisor. It basically is this. Cut taxes on payroll. Art Laffer, if he were here, would say he'd prefer a marginal tax reduction, as you would imagine, marginal rate reduction. But I talked him into the idea that, listen, we're dealing with a Democratic Congress. There's no way we're going to get a marginal tax rate reduction. Can we do it on payroll? So you start with a payroll tax reduction. Payroll tax is a FICA tax that you pay. It's 6.2% employee, 6.2% employer, up to now $106,800 worth of income. So we reduce that tax, and then we shift the tax, same amounts, it's revenue neutral. We shift the tax onto emissions, CO2. And the result would be that you set the economics right. Now, a very important part of this is that this is a border adjustable tax that we think is WTO compliant, such that it could be removed on export and imposed on import, so that you basically muscle China and India into action. You say to them, listen, bring your Barbies in. It's just that we're going to collect the tax on the Barbie. So now, do you want to go upstream with us, or do you want to be downstream and have this applied to your products? So our tax, the tax we're proposing, has an innovation curve that allows for a time period for innovation to occur. So it starts out at $15 a ton on carbon, ends up over 30 years at $100 per ton. But that's all negotiable with me. That rate, what that curve looks like and where it ends up is all negotiable with me. And I think that I can speak for people like Art Laffer in saying, if you're willing to go real low on some other tax, we can go real high on the shift. So how low you want to go on payroll taxes? Well, then we can go high on the other, and we can get some real innovation going. But the feeling that we had is you start at $15 a ton, you end at $100 a ton, so that you give this curve, this opportunity for innovation to occur. But the crucial part of it, of course, is that the consumer have money in their pocket to pay for the obvious increase in energy prices that would result as a consequence of any action on setting a price on carbon. And, of course, I think it's terribly disingenuous to the people involved in the cap-and-trade debate in favor of cap-and-trade side to argue that it's not going to cause an increase in electricity rates or transportation fuels. If it doesn't, then why are you doing it? So why not just be transparent and say, of course it's going to cause an increase in electricity rates and transportation fuels. Anything related to fossil fuels can go up in price. But if you start with a tax cut such that the consumer has money in their pocket and that they can thereby afford the innovation, then you've got something happening. The other thing that's essential, I think, is that where we're talking about with this steady curve and clear demarcation about where the rate would be, then you can see entrepreneurs out there deciding that they can convince the investors to marry them at various points along that curve. They can say, listen, we got an idea. We know the price point where it'll work. You got the money bags, so why don't you support our idea? We can take them there, or there on that curve. We can get to a place where we are sustainable and making a profit, and it's a very predictable, transparent price signal. The problem with cap and trade, I think, is that you don't have that transparency. You don't have that certainty. And the result is that, I know the theory is that the market will set the rate, but if you're trying to be this breakthrough entrepreneur, it's really hard to figure out where you're going to take the incumbent technology. So there's pushback on this idea from people that have decided to fall in love with the concept of the girl rather than the girl. We all had girlfriends that we fell in love with the concept of having a girlfriend rather than the actual girl. I think that's the case with most people with cap and trade. They've fallen in love with the concept of having a girlfriend. They've not fallen in love with the girl herself, because they look at the girl herself, she ain't too beautiful. So what we need to do is back up and say, now listen, let's look at the real girl here and figure out whether we're interested in cap and trade or whether we're interested in a transparent price signal. Now, as you know, cap and trade passed the House, pending in the Senate. I'm hoping that it collapses in the Senate. If it does, we've got the alternative. And the interesting thing is, I think that we can get some bipartisan consensus on this. There are a number of Democrats who've told me that they would sign on to this concept. They just need for cap and trade to fall apart. When it does, they're there with us. In the meantime, they got to support the administration, and support the leadership in the Congress that's trying to push cap and trade. Again, having fallen in love with the concept of the girl rather than the girl. So once we find out how many bumps and blemishes are on this thing, I think we're going to have a chance of convincing people, don't you want something that would actually work? That would send a clear price signal and be very transparent. So I'm hopeful that we'll get there, and I'm interested in answering any questions you've got about this concept or anything else. Yes, sir.
I really like your idea. I think it's a much simpler, more logical way to go. But I'm curious, how have you dealt with emissions from land use change?
The question is, how have we dealt with emissions from land use change? We haven't. So, good question. We should address that. I'm not quite sure how to tell you the truth, and so I guess I can't claim to have solved all the problems in the 15 pages, but I think it goes after the fossil fuel connection, not the land use issue. Yes, sir.
We've heard a lot from all the panelists today about, it keeps coming back to the idea of being revenue constrained. So there's a lot of confusion on this, but Nixon closed the gold window almost 40 years ago. If a country is no longer on any commodity currency standard, our money is not backed by anything except public will, public initiative. So how can any nation be revenue constrained? Why don't we just decide what we want to do and denominate all the transactions we want to make?
Interesting. So it gets
Laffer should know that emphatically. That's why when you mentioned his name, it came up.
So you'd suggest a return to the gold standard or something like that?
No. Just recognize that it's backed by public initiative.
Yeah.
Decide what to do first, and then create enough money so everybody knows what to do.
Well, you're beyond my expertise here, but I would say, my understanding is what you've got going on there is that you're really dealing with the current currencies. The situation we've got with currency is that it's mostly supposed to be tied to the productivity of an economy, which seems a pretty good way to peg it to me, rather than to a randomly occurring natural resource. So, yes, sir.
Yeah, thank you, Bob, for your comments. Could you explain a little bit more what you mean by taxing emissions?
Yeah.
In other words, I was intrigued by your concept and with the reduction in payroll tax, and then you talked about, I think, imports into the country, taxing those, but what will be taxed inside America in terms of carbon?
It's a $15 per ton tax on carbon dioxide, rising to $100 a ton over 30 years. That's what I'd propose. But again, what that curve looks like is I'm open to suggestion as to whether $15 is where you should start, or whether it should be higher, whether it should end up being higher than 100 or lower than 100, and what the curve looks like.
Is it all economy, all sectors of the economy, transportation, central station power?
Yes.
So it's essentially a carbon tax.
Yes.
Fantastic.
Yeah. By the way, I've learned it's difficult when people hear carbon on my side of the aisle, they break out in hives. And so what you have to do is you have to just sort of help them understand, listen, even I'm a commercial real estate lawyer when I'm not in Congress, right? And so I'm not much of a trial lawyer, but I can tell you that I'll stipulate, what I try to do with folks who break out in hives when they hear carbon is I say to them, I will stipulate that climate change is a bunch of hooey. Let's just assume it is total hooey, a complete fabrication. Still, you would want to act in order to break the addiction to oil and create jobs in America. Even if you think it's hooey, just play along. It's sort of like this. There are a lot of physicians out there who think that it is all about genes. Your longevity is decided by your parents. You got to pick your parents well. So what I would say to those physicians is, doctor, if I can diet and exercise safely, would it hurt me to do so? Well, not likely, right? I mean, it's probably going to improve the quality of your life, even if it doesn't extend your life. So I'd say to the people that break out in hives about the word carbon is, if you can take action safely for your economy, why not play along with it? If you can get to the place of saying to the Middle East, we just don't need you like we used to. And you won't see our troops, boots on the ground over there. We'll drop you some food from about 30,000 feet. It'll have copies of our Constitution written in your language, but you won't see us, and we could care less where the line is between Iraq and Iran. Put it wherever you want it. As far as we can tell, you got some sand down there. Looks pretty dry. That black stuff underneath the dirt, we just don't need it like we used to. That's national security. And then the job creation thing is, as Jeff alluded to, we've got 3 electric vehicle companies looking at the upstate of South Carolina right now. Any one of them is hundreds of jobs. We've got General Electric that makes wind turbines, bought the Enron business. They get 1,500 engineers and 1,500 production people in Greenville. We got Fluor Corporation, which can build nuclear power plants, design them and build them. And they've got thousands of engineers in the upstate of South Carolina. We got CHM2 Hill and Spartanburg. We had some exciting things. We got BMW that makes all the X5s and X6s now. Their first hybrid's going to be made in Spartanburg, South Carolina. We got exciting things going on there. That's why when I, again, had this primary opponent saying it's a doom and gloom, I said, Charles, no, it's promise and opportunity. Play it right, man. This is the triple play of this American century. You can clean up the air if that matters to you, but if it doesn't, forget it. Create the jobs and improve the national security of the United States. Yes, sir. Yeah.
Is your proposal mutually exclusive with the carbon cap and trade, or could we have cap and trade, which you don't like so much, but let that go ahead, since it might go ahead anyway, and have your proposal in addition to that? Is it going to hurt anything to have your proposal and carbon cap and trade?
Yeah, I think they're mutually exclusive. I don't think you'd want the enormous complexity of cap and trade when you could have this beautiful 15-page deal going on rather than this 1,200-page blemishes and bumps. And I mean, she is not beautiful. This 15-page thing is beautiful. So simple. Yes, sir, right there.
I'm very excited to be hearing a conservative solution to the problem. It's interesting to see people engage that way. I had some questions about your proposal. We saw the McKinsey cost curve earlier, and half of it is under zero cost, and yet nothing of that is happening. So what convinces you that adding $15 to the price of carbon makes any of that still happen when it's not happening now? And then the second part of my question is, what about kind of equity issues? It also came up earlier today. There are people who just aren't going to get the benefit from your payroll reduction tax and are going to be hit by the cost of increased energy. And people in rural areas are probably going to have higher energy costs and not benefit as much from the payroll tax reduction. So how do you deal with that?
Yeah, second question first. In the case of the biggest group of people that would not be benefited by a payroll tax reduction is, of course, seniors. And so what we're proposing in that 15 pages is another thing that I should have mentioned, which is a prospective adjustment to Social Security, a prospective COLA, so that you actually bump up the payments, Social Security payments, to anticipate the hit of the revenue-neutral tax swap. And then on the first part of it, I think that you do have to get a price signal that matters to people. And what we found out in the case of gasoline is it's $4, right? We proved that $4 changed behavior. I think that's been proven empirically. I know it anecdotally because I've got. It's been interesting, dialing for dollars a lot to hear from well-heeled people who said that $4 a gallon, it changed even their behavior. Because there's a sense that, gee, $4 a gallon for gas. I need to combine trips. I need to figure out maybe a carpool or something, put our family in one car rather than two cars. And so that's what we found out. There's some price at which, at $2.50 apparently it isn't changing much behavior. At $4 it really did change behavior. So there's some magic point that I think we found in the case of gasoline. Now the question is, what will it take in electricity to get Bob Inglis to put weather stripping on his den door? You can see daylight through the gap between our den door and the weather stripping, and I haven't fixed it. It's inconvenient to fix. I don't know how to do it. I mean, I tried to figure out how to do it. My wife bought some weather stripping and suggested that maybe I should try this, because our strategy so far is to turn the deadbolt lock, and it sort of forces the door more closed. So the question is, when will I overcome this inertia and go and put up the weather stripping? Well, what we obtain too cheap, we esteem too lightly, said Ben Franklin. And so I obtain power pretty cheap, and it's not worth it to me to go insulate to fix that door. So I got to believe at some point the price signal is going to be strong enough for me to decide that I'm going to go do that. And then what you got to hope for is entrepreneurs. This is where my conservatism becomes obvious, I guess, is that I'm counting on entrepreneurs innovating and making products that will be attractive to me, and thereby making a profit. They can be driven by their self-interest, and not by some altruistic goals that the government sets up through some grant program or this or that, but rather by their pecuniary interest of making money. And they're going to serve me, their customer, by making better refrigerators, better dishwashers, better all kinds of things, and we're all going to benefit from it. Yes, ma'am.
One of the panelists earlier spoke about an energy audit attached to the purchase of a new home as a creative way to sort of handle individual costs.
Yeah.
And I know that you mentioned you worked in real estate law. I was wondering sort of what you thought about that idea.
I think it's great if it develops in the free enterprise system. I'm not so enamored with it as a mandate, because I'm a small government guy. I want an elegant price signal, and I believe that'll drive the free enterprise system to solve this problem. If you go into mandating lots of things, think about it. My view is that that's a big government approach. I've voted for higher cafe standards. I wish that it wasn't the mechanism we were dealing with here. Because you think about it, that is a very regulatory, big government kind of approach to solving the problem. But if you send an elegant price signal, then the manufacturers say, oh, these consumers are going to care about what the efficiency of my car is, and they're going to judge me based on the efficiency of my car. I better get this car better. And that's what I'm after. And so I'd be very hesitant to impose some kind of an audit requirement on houses. I think it will develop. I wish I had. See, I should have figured this out from our first house. Our first house we bought for not much money because it was a little bit needed some repairs, right? And so we got to the first cold day in the house. We bought it in August, or moved in August. Along about November, we turned on all the baseboard heaters in the house. And I went out and watched the meter start smoking just about. We had a $300 electricity bill for this little house. Believe me, we were innovating within weeks of figuring out, gee, this is terribly expensive. And we really should have figured that out before we bought the house. In the future, I think people will English will get smart and check it out before he buys the next house. Yes, sir.
This needs to be the last question because we have another event
Yeah.
coming in.
So,
Thank you so much.
price signals. It's all fine and well to send price signals to a domestic economy that you have some both control over and responsibility to. I'm much more concerned about your contention that we can send price signals to China and India, and as you put it, muscle them into changing their structure, particularly if that then leads to what is a de facto consumption tax on American consumers if the price of those goods then go up, either because we produce them ourselves for more cost than we import them, or because the imports then go up. And I wonder what you would say to your constituents when that price signal is A, ignored, and B, leads to higher prices.
Well, consider the alternative. Cap and trade gets you a price signal for American goods, and then you export American productive capacity with no improvement of the environment. So actually you don't get the triple play of this American century. In fact, you get you don't get the cleaner air. You don't create jobs. I wonder if you can improve the national security that way. Maybe you can improve that. Maybe you can get to the national security goal. But otherwise, you're missing out on a triple play. But the key is that you got money in your pocket to afford the innovation, and that's why the key. What I'm insistent on is it must start with a tax reduction, and that this whole scheme be revenue neutral. That works for conservatives to make it revenue neutral if we can get through the breakout out in hives reaction. If you can just get through that, then I think conservatives will realize, oh, this all makes sense. This all rings true. You reduce taxes. At least Art Laffer says this. He says, what conservative wouldn't jump at the opportunity to reduce taxes on something you want more of? That would be labor, industry, income. And impose a tax on something you arguably want less of. He's agnostic as to climate change. He says he's not sure. But why not reduce taxes on something that increase tax on something that arguably isn't good? So you reduce taxes on something that you want more of. You impose it on something that you perhaps want less of. As long as you do that in a revenue neutral way, you're not growing government. You're actually creating jobs, and you're cleaning up the air, and you're improving the national security of the United States. So last thing I'd mention to you is just, I'm on foreign affairs and science. And one of the more interesting experiences I've had on foreign affairs is a lady named Ann Coren from Set America Free Coalition coming to testify. And it was amazing to watch Republicans and Democrats have the same exchange with her. She was there to tell us the bad news. You are oil wimps, but you're innovation giants. So now, go play your game. Well, Republican and Democrat, as they went back and forth, challenged the assertion, you are an oil wimp. Everybody, Republican and Democrat, wanted to find, well, what about this over here? Maybe we can get some in the Gulf. Maybe we can get some out in Colorado. Maybe we can, can't we get some? Every time somebody would come up with that, Republican Democrat, she'd say, you get 3% of the world's known oil reserves. OPEC has 70%. Do you want to continue to challenge Tiger Woods to a golf match? Why don't you figure out something else to do? And so finally came time for me to ask my question. And so I asked her, Ms. Coren, are you available to run for president? And what's interesting is a colleague had just handed down his BlackBerry, and he'd said to staff, how quickly can you get me Ann Coren for president bumper stickers? So he was apparently impressed with her as I was. And so I told her, here's what it is. You have really insulted us here today, because what we are is we are the guy, and I can identify with this, who is set up on the beach. I turn into a lobster immediately at the beach. No amount of sunscreen will help. And so I said, we've set up on the beach. We've slathered on the sunscreen, and wouldn't you know it, here comes this tan, beautiful lifeguard, and he's pulling his stand, and he has come right to where we are. And now the comparison is really bad. And so we can either figure out some way to get everybody with shirts back on, or and hand out the sunscreen, or we can figure out whether that lifeguard is any good at baseball. And if he's not, let's challenge him to go over to the baseball diamond. And so she's written this book. She says this book is about moving from the beach to the baseball diamond. And that's what we should be about as Americans. The American interest is to get off the beach, get off the sand of the Middle East, and get to the baseball diamond, change the game, create jobs, improve the national security of the United States, and clean up the air all at the same time. Thanks for the opportunity to be here.